But the risks are significant and the worst may not yet be behind us.
On the weekly data, those flows are just drying up from the Middle East.
A crash is right around the corner.
But I would not be going into the market and buying the index at this juncture.
This is already the worst energy shock in the history of the oil market.
Today on Alan's channel, we have had a massive market rally over the past few days. Just a few days ago, people were convinced that the market is going to get lower. But suddenly, everything just turned green. My own portfolio is up about 6% in just 3 days. I'll be showing you what's going on, what are the stocks that have ran up, and the reason why. We also have this debate going on, the debate over Iran. The overwhelming majority of comments and opinions that we are seeing online now around this situation have been vastly negative. People are explaining how dire it is, how the market is going to fall further. We also have people like Mohamed El-Erian on this train as well. He went on CNBC a few days ago and explained how bad things are right now. This of course makes investing very difficult when you believe you are going down a bad path. But we're going to be looking at it. We'll be going over this situation in this video as well. We also have an interview from Warren Buffett. He appeared on CNBC to give his view on the market right now. So that is a setup. Fear is high, headlines are ugly, expert warnings are everywhere, and yet the market just rallied hard. Now, this week, we have had one of the biggest rallies that I have seen lately. Overall, the indices were blindingly green. It was just a vibrant green across the board. Almost every fund that I have is in the green. In fact, if we look at how the underlying stocks has been trading, we can see that in the past 5 days, the big companies like Nvidia is up over 7%, Apple's nearly 4%, Microsoft 4%, Google over 8%, and even Amazon is up by more than 4%. So this was a massive 3-day surge. In my portfolio alone, this is around $6,900 of gains in just the past couple of days. That is how fast sentiments can change. 1 week people are panicking, the next week they are chasing green candles again. But what happened? What have caused this, and has anything meaningfully changed in the news? President Trump said that the US was set to leave Iran in 2 to 3 weeks, and that it doesn't need to have a deal for that to happen. So the reason that investors are rushing back to the market today and rebuying all the companies they just sold was because the president said something. He said that the war might end in a couple of weeks, which will of course be good news for the market. But we look at this and we see that not everyone is convinced. We have people now like Mohamed El-Erian, who is brought on to CNBC. He's a chief economic advisor at Alliance. CNBC typically brings him on when things are going bad, when things are happening, and he gives his takes on the outlook. And this video, like many of them that are striking and bearish and concerning, it went viral. It has over 100,000 views. Let's go ahead and just take a listen to his predictions.
All these tipping points that are being triggered in the war. I must say I'm more worried than the average. I'm more worried than the average because of the dynamics of the war. It's an asymmetrical war. You have 3 parties, now 4 parties, all of whom believe they're winning, which makes it very hard to end this war. And the US is the only one that can declare victory but can't impose outcomes. And I also look at the economy, and I'm starting to see demand destruction that can accumulate. And if you go to Asia, they're not just worried about higher oil prices, they're worried about actual physical shortages.
Right.
And that is another tipping point for the global economy. So in general, I've gone from reduced risk to maximum risk off to now a few names look attractive, but I would not be going into the market and buying the index at this juncture.
So his advice is not to buy the index today. It is not attractive. There might be a couple of companies here and there, he gives that caveat, but overall, do not buy the index, and he explains why.
I think there's no doubt that we are going to have not just an energy price shock. In my mind, we're going to have an inflation shock. Secondly, we are likely to see that inflation shock translate into less spending, particularly for the lower income households. So there will be a demand effect. If this continues, so you start with energy shock, interest rate shock, broader inflation shock, demand shock, then if this continues, which I hope it won't, we're going to be talking about financial instability. So that's the sequence. Hopefully we don't go all the way down, but that's the sequence that's been triggered by this war.
So there is Mohamed El-Erian's input. There's going to be shock after shock after shock. There's going to be inflation shock and demand shock and a price shock, and instability and a financial shock. And as this goes on, it's going to get worse and get worse. And when I look at this, how can you argue with him? It is difficult to argue with this logic. He's the one that has been trained to know these types of things. Now, to be fair, El-Erian is not wrong to highlight the risks. The risks are real. The war is serious. Oil supply concerns are serious. Inflation concerns are serious. None of that should be dismissed. But here is the key point. The mistake is assuming that scary headlines automatically means stock must keep going lower from here. Okay, and this is where many investors get trapped. Now, if we rewind a little bit, we can look at Mohammed's same advice that he has given, or at least similar advice in a different crisis. For example, if we rewind all the way back to March 2020, this was 2 days from the exact bottom of the COVID lows. The exact bottom, so like 2 days from the best possible point that you could pinpoint as the best time to buy stock. This was an extraordinary time to buy stock. In fact, if you had a crystal ball and you could see the future, you would have outlined March 2020 as the possible time to buy stock. Let's go ahead and listen to what Mohamed El-Erian said that day.
My warning has been economic sudden stops start small, they cascade, and then they reach critical mass. Over the weekend, we reached critical mass globally, and now we have reached critical mass nationally. And that brings the whole economy to a virtual stop. It will start, unfortunately, disrupting more and more relationships. It is something that is necessary because social distancing is the only way to stop this virus from what it needs to spread. So it is, people will rightly put health in front of the economy, but there will be significant economic and financial damage.
Back then, he was expressing the seriousness of the situation in a very sobering way, explaining how things can go out of control. And he even goes further with this. He even goes further explaining how dire the situation is on the March 2020.
And we're starting from an initial condition where the cognitive mindset is not open to what we're going through. Very, very few people understand the economics of sudden stops. Even fewer understand the economics of fear, and we're just starting to understand the economics of circuit breakers. So the analytical underpinning are massively catching up. All this is a long way of saying that I fear, John, that people are still over-optimistic. They're applying old mindsets, old model. They're looking for precision that doesn't exist. This notion that you can predict GDP declines, we simply don't know. There's so much we don't know. But my feel is that consensus, unfortunately, is still too optimistic.
He thinks that the market was just overly optimistic and investors were naive. They just did not understand. He understands, investors do not. Now, of course, that was literally the bottom of the market. If you bought that day, you bought the exact bottom. So this is not try to discredit everything that Mohamed El-Erian said. That is not the point of it, okay? And I do believe that he is educated on this subject. He understands them very well. He understands economics. But the point is, it remains that being an economic risk does not necessarily help with investing. Peter Lynch has highlighted this again and again. Peter Lynch, someone who was actually great at investing, he got market-beating returns for 13 years. He compounded nearly 30% for 13 years. He has made hundreds of millions of dollars for himself and billions of dollars for Fidelity. He is an investing legend. And he says that if you spend 40 minutes on the overall economy, on economics, then you have wasted 12 minutes. He says that there is always something to worry about. Economists are always talking about the gloomy future. And this was back in the time when Peter Lynch was investing. We see the same story playing out today. Very similar characters, very similar fears, very similar warnings. Mohamed El-Erian, every time something goes wrong and stocks go down, he would come out and give reasons why it is going to go down further, why it could get worse, why investors need to hold off, why they are naive and overly optimistic. A day after his viral interview where he warned people out of the market rallied. The best rally in 10 months. Many of the best companies surge forward. That does not mean that anything he said is necessarily wrong. All of his predictions about this war, about what could go on, and about how serious it is, all of that could happen. But investors need to understand that if you do not wait for things to get better before the market recovers, that is not how how the stock market works. The market does not wait for the perfect clarity. It does not wait for comfortable headlines. It does not wait for you to feel safe again. It's not going to recover once the Strait of Hormuz is back open, or once the oil production is back up to full productions, or even once everything looks good again and then investors start buying back into the stocks market. That is usually not how it works. Investors are forward-looking by years, sometimes by decades. They price in risk immediately, and that's why stocks fell before their earning release. They fell before going into this war, and earnings may still be rising throughout all of this, but stocks have already gone down. So that's also why stocks will go back up before all these problems are fixed. Much before. Long before they are fixed. So when we look at what is going on, you have to differentiate between how big these problems are, how long they will take to fix, and when that will be priced in. The pricing in of the recovery will be much faster than how long it actually takes to fix these issues. It will be months and months and possibly years faster. And this matters when you are buying the US stocks directly, holding global funds, or just sitting in Singapore watching your portfolio and wondering whether you should have waited or whether you should have invested. Because for regular investors, the real lesson here is not that risk has disappeared. The real lesson is that markets often move ahead of the news. So if your whole investment plan depends on waiting until everything feels safe again, you will usually be late. That does not even mean you ignore risk. That does not mean that you're going to blindly buy everything, but it does mean that you need to separate scary narratives from actual long-term opportunity. Another person that I like getting input from during times like this, especially during times of war or rocky news, is Warren Buffett. He's pretty old, but he has been through a lot of market downturns, and so I like hearing his input on the subject. When the market drops 7%, most people is going to panic, but Buffett calls that as a background noise. So let's go ahead and listen to one part where he addresses this in a recent interview, and this is just a few days ago. In this interview, he talks specifically about this sell-off in 2026.
Well, you've got both the Dow and the NASDAQ in correction territory. It's the worst performance on a quarterly basis for stocks in about 4 years. Do things look cheaper to you?
No. And he says no, it does not look that much cheaper. And he tries to give context into what he's talking about here, the point that he's making.
3 times since I've taken over Berkshire, it's gone down more than 50%. I mean, if you look at the markets of, the worst probably was the 2007-8 period, although there was that one Monday when you had 21% in a day. I mean, this is nothing.
Buffett has a common theme in every interview. His timeline is much longer. Over his investing career, he has endured through 3 50% sell-offs. Those are something. That is when stocks are getting cheap. So by comparison, when the S&P 500 goes down 7% this time, to him that is just shrugging his shoulders. It's like nothing. It's like another Tuesday. So Buffett does not even really look at this as relevant enough to change the way he views quality companies. So it is a completely different timeline, and this is really the heart of the whole video. The difference between reacting to headlines and investing with a real-time horizon. Because when fear is high, every explanation for why things will get worse sounds very convincing, right? Every bearish argument is going to sound brilliant. Every risk feels heavier. But the market is not asking whether the news feels scary today. The market is asking what the world might look like months and years from now. So for me, this week is a good reminder that the market does not wait for comfort. It does not wait for clear skies, and it definitely does not wait for everyone to feel confident again. The headlines may still look ugly, the risk may still be real, but markets are forward-looking, and that means recoveries often begin long before the news starts to feel better. That does not mean you ignore risk, it does not mean that you blindly buy everything, but it does mean that as an investor, we need to separate scary narratives from actual long-term opportunity. So the real question is not whether the news feels bad today, okay? The real question is whether that fear has already been priced in. Let me know what you think. Do you believe that this rally has more room to run? Or do you believe that the market is being too optimistic again? If you enjoy this breakdown, make sure to like, subscribe, and I'll see you in the next one.